Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire. And today I'm joined by Chris Payton, who's the Chief Investment Officer at La Trobe Financial. Now, I'm sure many of you have heard about La Trobe Financial, but we're going to be diving into a bit of background about La Trobe Financial and learning about some of the opportunities they're seeing in the market, particularly for income-focused investors. Chris, great to see you. Thanks so much for coming into Livewire today.
Thanks for having me. Great to be here.
Now, I'm sure many people have seen La Trobe Financial around advertising, would have heard about some of the income products that you produce, but perhaps tell us a bit of background about yourself.
Yes.
And tell us a bit about the firm.
Chris Payton's my name, Chief Investment Officer. Been with the business now for almost 8 years. La Trobe Financial, the home of retirement-focused income solutions, a market leader in that space. As a business, we manage over 20 billion in assets on behalf of over 100,000 investors, 4,200 advisors placing funds into our strategies. We've been around since 1952, so we have over 70 years of experience in our foundational asset class of private credit, and certainly a market leader in that space.
Private credit's topical at the moment. Sounds like it's been part of what you do for a long time.
It has been. It's really the way the business was founded was focused on private credit. Very topical. It's not a new asset class. It's been an asset class. We've been in there for 70 years, but around a lot longer than that. There's a lot more activity around that space, a lot of attention in the markets around private credit and private markets. Certainly caught the attention of the regulator, who is looking to do a bit of a deep dive and understanding on the private markets and the growth in those sectors. We welcome that. We've been around the market for 70 years. We know that with the economies of scale now, that there's critical mass in these markets that are making investment opportunities available for retail investors. So with retail investors firmly in our minds, we think it's a good thing that there's a light shone on the industry. If it increases transparency, ensure there's appropriate robustness around valuation practices, for example, it just helps retail investors ensuring that they know what they're investing into.
What do you think are some of the best practices that you would like to see implemented around the private credit asset class?
Transparency is one, and it really goes to our DNA as a business. We have a deep commitment to transparency in our La Trobe Australian credit funds. We put up on our website for the world at large to digest thousands of data points on each of our portfolios. We pride ourselves on transparency. We do think we're market leading in that space. Again, with a retail investor firmly in mind, ensuring that they understand what is happening in our portfolios, that they can monitor the performance of our portfolios. We want them to have as much conviction on our portfolios as we do, so we provide that information to them. And that's what we'd love to see the industry more broadly embrace as well, that same level of transparency that you see more in public markets starts to feed into the private markets as well.
Well, let's zoom out a little bit. We're not far off the back of a recent interest rate cut in Australia. And I guess there's a few questions around the economic outlook. We've still got inflation a little high, quite a bit of uncertainty. What's your assessment of the backdrop and particularly the key considerations for investors that are seeking income?
Yeah, I think it didn't really come as a surprise to many, the move by the RBA in February. Really a reflection of where we are from an economic perspective. Inflation, yes, on watch, but largely under control, with fully employed population, so there's resilience in our economy that we've seen over the last 5 years, frankly. So the timing probably about right for the cutting cycle to commence. I don't think it'll be a deep cutting cycle, certainly not with the more macro picture that we have at play, so maybe higher for longer will remain the thematic. What does it mean for investors? Well, we're not going to return from where we came from, which is that really low rate environment. So there will be a yield curve in market. They will be able to find yield, but it's about low volatility. So the flight to quality that we've seen over the last 5 years, we think that will continue. And certainly for investors looking for income, it's ensuring that they can find that income, but without attracting outsized volatility with it.
I can hear a sigh of relief from some of those people that have been enjoying the higher interest rate environment from the income perspective. From your experience over cycles, what's the key to being able to retain a decent level of income, even if there is a reduction in the official cash rate?
Diversify portfolios, whether you're an investor and ensuring you have diversification across different asset classes, different sectors, that's important. And certainly as a manager likewise as well, ensuring that your portfolio has the resilience of, for us, residential mortgages, which provides that stability for investors, but then having tactical allocations or strategic allocations towards commercial real estate and light industrial development finance that provides a little bit of a yield uplift without taking on additional risk. That's important, but ensuring that from an investor's perspective, they're well diversified.
There's quite a bit of big news in markets at the moment. We've got big stories coming out of the US, which is really creating some uncertainty. We talked about some of the focus within your asset class on parts of the private credit market that people are maybe getting a little bit concerned about. Is there anything that you think on those front page stories really impacts people who are looking for that reliable income?
If we go back to the focus on private markets, the rise of private markets and private credit, for income-focused investors, ensuring that they really understand what they're investing into. The proliferation of private credit has meant that there's a lot more managers now in market, more recent managers, more recent entrants that don't necessarily have the battle scars and the war wounds through different cycles, haven't experienced a GFC or a COVID pandemic or even a liquidity event in SVB. So they're untested to some degree through those cycles. So for investors, it's really important that they do understand the manager, their experience, their fundamentals, and then also the portfolios. So we always encourage that. Not, from my perspective, for investors, not looking to chase trends in market as well. That's where you can catch yourself out. Invest with patience for a long time. Don't invest for a short time and expect to generate strong yields without taking on additional risk.
Could you maybe talk through some of the risk management processes and some of the safety nets that you put in place to ensure you deliver that smooth income stream, because that's what people rely on you for? Yeah,
and perhaps if I go back to start with what we've delivered for investors, and I'll tell you how we do that. So for investors in our strategies, what we're most proud of is that no investor has ever suffered a loss of their capital in any of our portfolio offerings. So that's a 35-year track record in our asset management business, 72 years, 73 years as a corporate more broadly. How we're delivering that is our focus. It's not by accident, by design. It's a focus on our investment fundamentals, quality of assets, diversified portfolios, and a margin for safety. Quality of assets, from that perspective, we are peerless in our chosen market segments. We're originating about $1.7 billion in new loan assets each month, deploying about $1 billion into those new loan assets. So our portfolio managers, they can be highly selective in the loans that are coming into our portfolios. We like to track the credit scores of our borrowers, not that we're a credit score lender, but we do track it. The credit scores of our borrowers on average track very closely to those of the big four banks, and certainly a premium to the non-bank financial institutions. So when we say quality, we mean quality. Diversified portfolios, there's 10,584 loans in our 12-month term accounts. That's an almost $10 billion fund. So average loan size is about $900,000. So lots of small loans, diversified exposures, ensuring that not one loan is going to drive the investment performance for our investors. Diversification across sectors, across geographies, and then margin for safety. What do I mean by that? We ensure that we have a low loan to valuation ratio across the portfolio. 12-month term account sits at 64%, meaning that there's 36% of equity on average that needs to be eroded before the first dollar of investor capital is at risk.
And could you give me a flavour for the underlying assets? What are people getting exposure to?
Yeah, so very much residential mortgages over properties, whether it be as an owner-occupied or an investment property, some small-scale commercial real estate, light industrial assets, some small to medium development finance, nothing more than $25 million within our portfolio. Again, ensuring that we're not taking outsized risk for our investor base. So really high-quality assets, diversified across those sectors. As I said, we like the resilience of the residential asset class. That sits at about 60% of our 12-month term account today.
Yep. And are the parts of that property and construction market that you're steering clear of, because that has been making some headlines?
Yeah, we try and, up to $25 million is our maximum. So we're talking about your small-scale developments, your multi-townhouse style developments. We're not talking about your big high-rises or anything like that. That's not the area of focus for us. When we talk about diversification, we also talk about diversification from builders and developers, ensuring we don't have any outsized concentration on one of those. Again, we've seen the headlines around the building sector over the last 5 years or so. Our investors, nor have we, been materially impacted. So to that point, ensuring that there is good diversification, focusing on high quality builders, that not those high volume, low margin builders that are most susceptible to movements in the market.
Yeah. There was quite a bit of concern around what the impact of that aggressive rate hiking cycle was going to have on loan arrears, particularly for residential mortgages. What was the experience, and I guess what are some of the misconceptions that you see around RMBS?
Yeah, I think as a headline, Australians perform very well. We are a very compliant country. We will look to service our mortgages and pay our mortgages where we can and sacrifice on the lifestyle. So there's the court case around Wagyu and Shiraz and opting to go cask wine and chuck steak. That's just the Australian mindset. So the experience through that rapid interest rate cycle was one of resilience from the Australian borrower. Arrears for us remained in the historical range of 2.5% to 4%. They hit around 4% at their peak. Yep. So a very resilient asset class, very resilient borrower base. Reflected also in the fact that we had that fixed interest rate cliff that everyone was talking about, which passed with barely a whimper by the end of it all. Yep. Helped by the fact that Australians had raised hundreds of billions of dollars in excess savings, 280 billion of excess savings across the COVID pandemic. They didn't use all of that. They didn't need to use all of that to service their mortgages after the interest rate cycle had moved. But again, remaining very disciplined in the way that they were living.
Yep. Let's change tack. We've been talking predominantly about the domestic investment activities and the opportunities that La Trobe Financial sees. I understand you've also taken some steps to the US. Why the US market and why would you step outside of Australia?
We're always looking for additional high quality offerings that we can bring to our investors, and particularly in parts of the market that they can't traditionally get access to. Those parts of the market traditionally reserved for institutional investors. And our US private credit strategy is really ticking those boxes. We like the US middle market in particular because of the size of what it is. As a headline, what's this product providing? It's providing access to a portfolio of first lien senior secured loans to US middle market companies. And these are companies owned by some of the largest private equity firms in the world.
The middle market, put a bit of colour around it, because I feel like it's a bit of jargon that people might not be across.
Yeah, that's right. So it's a huge market. So the US middle market is really any company that has anywhere between 25 million and $1 billion of EBITDA. It represents over 200,000 companies, a third of the total jobs in the US, 40% of the US GDP. If the US middle market was its own economy, it would be the third largest economy in the world. Right. Australia, for context, it's at number 13 on that list. Yep. So it's a huge market, a very deep market, and it's a market that's benefiting from the political agenda over in the US at the moment, the growth of the pro-growth agenda that Donald Trump is rolling out. Think about deglobalization, the reshoring of critical jobs and manufacturing, which will really rebuild the heartland of middle America, the US middle market. Yep. So for us, providing our investor base with access to that asset class in the unique way that we're offering that's really exciting.
And could you talk through, for investors that might be considering it for a part of their portfolio for income, what sort of returns are you targeting or are you hoping to achieve? So
we're bringing that to market in partnership with Morgan Stanley. So Morgan Stanley, a blue chip name of course, but they are a market leader in that US private credit middle market space. For investors, they're investing into a La Trobe financial vehicle, an AUD denominated vehicle, and they're accessing that portfolio through La Trobe. For investors, it's monthly access, quarterly liquidity, and from a return perspective, we've been delivering 9% for wholesale investors each and every month since inception of that strategy, net of fees, pre-FX movements.
I was on Bloomberg the other day and an interesting chart popped up showing just how tight corporate credit spreads are for publicly traded credit.
Yes.
What are some of the implications of that for the part of the market that you're looking to access?
Yes, you're right. You've seen some real compression in the spreads, more so in the upper middle market. That's where the banks will still play in the public markets, but it's also where some of the larger asset managers need to play. So your Blackstones, your Ares in particular will be riding at that upper end of the market. It's ultra competitive. That's why we like the US middle market. Competitive, yes, but less so. What it means is that, and part of the reason we chose Morgan Stanley, you've got to be highly selective in the loans that you're putting into your portfolio. Morgan Stanley are differentiated in that they're not coming to the table like every other asset manager with a loan at a price. They're coming to the table with a full service offering. They can bring their investment specialists to the portfolio companies and the private equity firm, their hedging specialists, their capital market gurus. They can bring all of those to the table, and is meaning that the private equity firms are ultimately wanting Morgan Stanley to be leading these transactions for them because they can provide that full service offering to them and their clients ongoing, as opposed to it just being a loan at a price.
Yep. Just bring it back to the investor that might be sitting at home thinking about, do I need to be more diversified? La Trobe Financial's got this track record of delivering the capital stability and the income for a long period of time from the Australian market, what's the case for adding exposure to the US if the Australian product is doing such a great job?
Yeah, it's about the global diversification. I mean, the Australian GDP represents about 2% of the world economy. The US middle market's at about 15%. So getting access and diversifying your portfolios, we always encourage adding a little bit of resilience through diversification and broader exposure is certainly helpful. But again, it's very important to understand what you're trying to solve for. So if you're looking within your portfolio to be able to add some diversification, but you don't want to take on any additional risk, then you need to focus on the particular parts of the market that are going to deliver that sleep at night income stream that you've been prizing. That's what our US private credit portfolio is designed to do, to develop and deliver that consistent monthly income stream for investors, that low volatility investment. But you have to give some thought as to whether you want to diversify also from a risk perspective. Do you want to go down the opportunistic credit path and take on additional risk? Is there particular sectors, particular economies that you like or want to avoid? So that's absolutely critical to an investor's thinking and constructing their portfolios.
Okay, you mentioned earlier $20 billion in assets under management. You've got the role Chief Investment Officer. What keeps you up? What makes you nervous?
For me, it's always keeping the customer at mind, front of mind. So we always remind ourselves that we're managing the wealth of 110,000 individual investors that have had a career, that have worked hard to raise that money, and we're stewards of their capital. And we've earned their trust in that they've placed it with us. And for me, it's ensuring that we never lose sight of that. I personalise it. I think of my parents and the fact that there is 110,000 individuals just like them. So it comes into our ethos as a business, ensuring our investment products are simple and easy to understand, ensuring that we're being very transparent in the way that we're managing our portfolios, ensuring that the investment decisions we're making are in the best interests of every single one of those investors. So that's how we approach it. It keeps me up at night because I'm very conscious of the fact that I've got the trust of 110,000 investors placed in our business.
Well, Chris, thanks so much for coming in. It's been great to meet you. It's also been awesome to learn a bit more about La Trobe Financial and the income products that you provide for investors.
Thanks for having me.
Ladies and gentlemen, I hope you enjoyed that chat with Chris Payton, the Chief Investment Officer at La Trobe Financial. They're an income-focused firm. You can check out more information in the links below this video.